Hi, I'm Lango, and this is Quick Picks, where we communicate to you some of the market's best investment opportunities in just 3 minutes. Today, we're going to be talking about a beaten up retail stock named Foot Locker, ticker FL, that represents one of the market's best investment opportunities over the next 12 to 24 months, a stretch in which I think the stock can double. Here's why. Foot Locker stock, along with every other retail stock in the market, has been absolutely crushed in 2020. COVID-19 came in, closed all physical retail stores, consumer spending fell off a cliff, especially on discretionary items like clothing and apparel. It's no surprise then that Foot Locker reported a 43% drop in comparable sales in Q1. But along came Q2, and Foot Locker reported an 18% rise in comparable sales. What that broadly says to me is that this company's figured it out. They know exactly how to, despite these extremely unusual macro conditions, sell footwear, and trendy athletic apparel to the consumer, and they're doing that by selling online. Digital sales in Q2 for Foot Locker rose more than 170% year over year. Okay, but despite those blockbuster blowout Q2 numbers, Foot Locker stock is still way depressed, and that's because of two prevailing fears surrounding this company. One, the COVID-19 pandemic is gonna last forever and kill consumer discretionary spending forever. And two, the athletic apparel distribution model, which is being narrowed down and streamlined, is squeezing out Foot Locker. But both of these fears are overstated. Here's why. First, the COVID-19 pandemic, yes, it's going to be with us for a long time, but a vaccine is going to spark rapid consumer behavior normalization. That vaccine will probably arrive in 2021. When it does, consumers will feel more comfortable going back into stores and buying clothes. They're going to feel more comfy going back into a Foot Locker store. That's a tailwind for Foot Locker over the next 3 to 6 quarters. Two, yes, the athletic apparel distribution model is being squeezed down, but what's happening really is that Nike, Under Armour, those guys, they're cutting out all the low-hanging fruit. They're getting rid of those really bad, ugly sales channels. Foot Locker is not one of those. Foot Locker is a premium sales channel. It's differentiated. They sell premium products. They got great brand equity. They're cool, right? So Nike and Under Armour, those guys, they aren't cutting back on Foot Locker. If anything, they're increasing, they're upping on Foot Locker because it's now a bigger piece of the pie. So fear about being squeezed out, overdone. So now let's do some numbers on it, right? We have a $29 stock, about $4 in EPS projected in 2021. That's about 7 times 2021 earnings. That's just way too cheap. My numbers say this company can stabilize revenues and margins, get to about $5 in earnings per share, put a 12x multiple on that, which is historically average for the stock, and that's how you get to a $60 stock price. We're at 30 today. That's 100% upside potential. Okay, well that's all we have for this edition of Quick Picks. I hope you like what you saw. If you did, please sure to subscribe, hit that notification bell, and if you like to read, come visit us over at investorplace.com where we have some of the market's best analysis. Until next time, cheers and happy investing to all.